This video will discuss the issuance of bonds payable at par. When companies need to raise cash, the issuance of bonds are one way to accomplish. The advantages are that bonds do not affect the owner control of the corporation. Interest on bonds is tax deductible, and bonds can increase the return on equity. However, the disadvantages are bonds require payment of both periodic interest as well as the par value upon maturity of the bonds. Bonds can decrease the return on equity when the company pays more in interest than it earns on the borrowed funds. The basics of bonds. On the bond issue date, a corporation receives cash from investors. Over the life of the bonds, corporations will make interest payments every 6 months, typically, until it pays the bonds back. Basically, what is happening here is corporations are borrowing cash from investors. When we borrow cash, we have to pay interest. Interest is the cost of borrowing money. So the company is borrowing cash, paying interest over the life of the bonds, and then when the bonds mature, they pay off the debt. So let's look at an example. ABC Company issues these bonds on the 1st of January 2019. The par, or face value of the bonds, is $1 million. The stated or contracted interest rate is 10%. The interest dates are June 30th and December 31st. The bond date is January 1st of 2019. They are 20-year bonds, so they mature on December 31st of 2038. When the corporation issues these bonds, because they are issued at their par or their face value, the company is selling the bonds for $1 million, so they're going to receive cash of $1 million, debiting cash, and they will credit the liability bonds payable. After 6 months passed, it is now June 30th of 2019. The investors, the bondholders, are ready for their first interest payment. So on June 30th, the company must make a journal entry to record the first semi-annual interest payment. The amount of interest is calculated by taking the par value or face value of the bonds, $1 million, times the stated or contracted interest rate, 10%, and because these rates are stated in annual interest rates, we have to take that annual interest and multiply it by the fraction of the year. So because they're only paying interest for a 6-month period, January 1st through June 30th of 2018, we multiply the annual interest by 1/2 of a year, or 6 out of 12 months. The company must pay the investors $50,000. So we debit bond interest expense and credit cash for $50,000. This journal entry will happen again after another 6 months passed. This entry is made every 6 months because every 6 months the corporation has contracted to pay the investors interest of $50,000. So for 20-year bonds, this interest payment is made 40 times. So this journal entry is made 40 times over the life of the bonds, every 6 months. On December 31st, 2038, the end of the 20th year, the bonds mature. ABC Company makes the final interest payment, so they debit bond interest expense and credit cash for $50,000. Because this is the maturity date, they also must pay off the bonds. The liability is for $1 million, so they debit the liability to decrease it and credit cash for $1 million. The debt has now been extinguished. The debt has been paid off.